Okay, so in this video we are going to learn about what is forex trading and how it works. But before we start, if you are new to this channel, kindly subscribe, like and share to all your friends to support this channel. Okay, so let's go. So forex trading, let's take forex. Forex simply means foreign exchange, and forex trading means trading the exchange of foreign currencies. So trading two currencies at the same time is a form of forex trading, or it's what is termed forex trading, trading two currencies. Let's say you're in Ghana and you go to USA. So USA spends that currency as the US dollars, and you are a Ghanaian having Ghana cities. So the moment you get to the land of USA, there's the need to what? To exchange your currency, which is giving out your Ghana cities to a forex bureau or a forex trader in that country to get the US dollars to trade everything you want to do or to use it in your rounds in the country. So that exchange of that currency or that trade between your Ghana city and the US dollars is what is termed as forex trading. Okay, so in forex trading, it is very important to understand who is trading the forex market and why. And this brings us to the actors in forex trading. And number one and the major actor in forex trading is the central bank. So the central bank here are government institutions that manage a country's money supply and currency. And we can consider some examples like the Federal Reserves, Bank of England, and the European Central Bank. And the most important thing here is understanding why they participate in forex trading. The central bank in particular participates in forex trading to control inflation by adjusting interest rates and also to stabilize currency value, to prevent sharp falls and rise in currency values, and also to manage reserves through the buy and sale of foreign currencies. And the last is to support economic growth through monetary policies. So let's take for example, if a central bank raises interest rates, investors may buy that country's currency, causing it to rise. Second actor we can talk about is the bank, being it commercial or investment bank. So unlike the central banks, these banks trade currencies daily for themselves and for clients. So we can consider some examples like the JP Morgan chains, the Goldman Sachs, and so many more. And here's why they participate in forex trading. So one, the banks participate in forex trading to facilitate international payments or exchange money for customers or act as a hedge currency risks and what speculate to make profits. And an example is that a bank may exchange millions of USD to euro for a multinational company importing goods. And this is one of the ways these banks or commercial or investment banks makes money or makes profit through forex trading. And don't forget, these banks makes up a larger share of daily forex volume, and especially the major global banks are the corporations. Yes, so the corporations here are large companies involved in international trade. So we can talk of Apple Incorporation, Toyota Motor Corporation, or the Coca-Cola. Yes, so these corporations trade because, or the reason why these corporations trade is so that they can pay suppliers in foreign exchange. Because this Toyota Incorporation or Toyota Motors Incorporation, they are companies that are what are known internationally. These are companies that are what are known internationally. So they what will involve themselves in what forex so that they can what make exchanges of in currencies. They can what they can exchange currencies in order to what to pay suppliers in foreign currencies and also receive payments from overseas customers or convert profit earned abroad so that they can what they can convert their profit they earn abroad. That is why these corporations involve themselves in forex trading. Yes. So let's take a look at example. If Toyota Motor Corporation sells cars in what in the United States, it may what convert the dollar into Japanese yen. That's the JPY, from the USD to the JPY. And this is all about the corporations as an actor in what? In forex trading. And don't forget, corporations basically what? Trade or involve themselves in what? In forex trading for business needs, not for speculation. Not like the banks or the central banks. For corporations, they trade for business needs. So now let's look at the last actor, which is you and I. And you and I, we are called the retail traders. So these retail traders are individuals who trade forex through brokers using online platforms like the XNET, the FS Trade, MetaTrader 5, 4, MetaTrader 4, and etc. Okay, and here is why these retail traders works participate in forex trading. So one of them is to what? Is to profit from the currency price movements in the market, and also is going to serve, or some people will use to serve themselves as a part-time or full-time trading income, and also a portfolio for diversification. And the last thing is to learning about the financial market. So these are the reasons why these retail traders participate in what? In forex trading. And you should note that we retail traders are very smaller than the banks and the central banks, but we are growing part of forex. We are the growing part of the forex market due to the internet access and mobile training or mobile trading. Yes, so we are smaller than the central bank or the banks, but we also benefit or what? Speculate and also what? Profit from the market or the forex market. The forex market has a hierarchy, meaning some players control more money, more liquidity, and more market movement than others. That is why I'm going to break down this forex trading hierarchy for you. What is forex hierarchy? The forex hierarchy is simply the ranking of participants or actors in the foreign exchange market based on power, money size, influence, and access to liquidity. So the higher you are in the hierarchy, or the higher you are in the hierarchy, the more influence you have on price movement. So the lower you are, the more you add to price what? Movement. That's basically it. So let's look at the central bank, which is the top level. So we said previously that the central bank is the major actor in forex trade. So now let's look at it on the hierarchy. The central bank. So in this pink box is the central bank, which I told you about, the Federal Reserve, European Central Bank, Bank of England. So these banks I've mentioned can be considered as the central banks, or are considered as the central banks. And why are they at the top? Because the central banks print money. So this is the central bank. They print money, raise or lower interest rates, control inflation, stabilize currencies, influence the entire company of a country. So let's take some example. When the Federal Reserve increase interest rates, USD offers become what? Stronger, because it's going to attract what? More investors. Yes. So the second level, which is the major banks, the second level, which is the major banks in this green what? Box. Example I said earlier, the JP Morgan Chase, the HSBC, the Citibank, and etc. So with these major banks, their role is to provide liquidity to the forex market. So they will provide what? Liquidity in the forex market. They what? Exchange currencies for clients, trade huge positions, hedge risks, speculate for profit, and create interbank what? Prices. And their importance is that they trade directly with each other in the interbank market, where the best prices was exist. So if central banks control policy, major banks control liquidities. That's basically the trend. If the central bank controls the policy, the major banks the major banks will control the liquidity. So the central bank is controlling policy, major bank will control what? Liquidity. So the third, that's the commercial company in the yellow box. In the yellow box. So we have the commercial companies or the corporations. So this example, we say the Apple Incorporations, the Toyota Motor Corporation, the Amazon, and etc. And so why these people are part or what are linked in this hierarchy? So because they do international businesses, that's the main reason why they are part or what they are in the hierarchy. So they what operate in what international businesses. So you can see Toyota cars in USA, Europe, every country internationally. So before you can buy a Toyota car in Europe, you have to have a euro or that currency euro in that country before you can buy a Toyota car. And if Toyota is based in USA, when this car bought in euro, the money is being exchanged or is being brought back to the company. It's going to be what? It's going to be exchanged into what? Into USD, because the company is based in what? In United Nations. So the teaching line is that companies don't trade forex to gamble. They trade because businesses requires it. That's the commercial company or the corporations. These companies, they don't trade forex to gamble with, but they trade because the company or the business requires it. That's what I've explained earlier. They require this forex. That is why they trade or they are involved in it. The fourth one, which is we retail traders or speculators. They include the hedge funds, investment funds, pension funds, or large speculators. So their goal is what? Is profit. That's the hedge funds. Their goal is profit. The investment funds or the hedge funds, their goal is to make profit from the bank or the forex market. For example, we have the BlackRock, the Bridgewater Associates. So why is this matters? When they enter the market, they can create what? Momentum. These people create momentum when they get into the market. So and the teaching line here is that when smart money enters, trend becomes what? Stronger. So when these people enters the market, it makes what? It makes trend become stronger. So we'll be learning trend in our next video. So for now, let's look at who these financial investment funds are. So let's look at the last one. That's the what? The financial or the market makers. The financial or the market makers. So these are the intermediaries. These are the intermediary between institutions and we the retail traders. These market makers, they are the intermediary between the institutions and we the retail traders. So they create prices and may take the opposite side of clients trade. So when a retail trader is speculating that a USD or a currency pair like USD JPY is going to buy, these market makers are going to sell, so that what? You the retail trader can get what? A profit, because when there's no a buy or when there's a buy, there should be definitely what? A sell for that buy of yours to what? To be complete. And the bottom level, which is the retail trader, these are individual traders like me and you watching this video. So these retail traders trade through brokers using small capital amounts. So they have less market power, smaller trade size, higher spread cost. So when we talk about spread, we'll be talking about spread in our next video. Yeah, we'll be talking about spread in our next video, and I'm going to help you with calculate spread, what really is spread, and how these institutions charges spread. So they are like fees. Spreads are like fees, but we'll be looking at them in the previous video or in our next video. Sorry. So The truth is that retail traders do not move the forex market. They only participate in movements created by what? Bigger players, the major banks, investment funds. Those are the bigger players. And we, the retail traders, make move and are required to think like this market makers, investment banks, because we don't move, because our contribution is very small and can never move the forex market. We ask is to what? Is to follow or trade like in line with these market makers. So this brings us to the end of this video, and now let's look at this last thing, the advantages of what? Forex trading. So high liquidity, easy to buy and sell, 24-hour market access, low starting capital, leverage opportunities, low transaction costs. And now let's recap whatever we have done today. So we said forex trading is simply the trade between two currencies, yes, traded by banks, corporations, and retail traders. And their advantages is what? High liquidity, low transaction cost, low starting capital, leverage opportunity, and 24-hour market access. Thank you for watching this video, and don't forget to like, subscribe, and share to all your friends. Meet you at the next video. Thank you. Bye bye.